Hello, everybody tuning in to my Data Science 4100 final project. For my final project, I will be comparing currencies in Bitcoin. Specifically, I'll be trying to determine if the change in a given currency's value over a fixed interval of time will translate to a change in that same currency's volume of exchanges between itself and Bitcoin in the next time interval. An example of this being the US dollar declines by 3% in the month of January. Will this translate to an increase in the volume of exchanges between the US dollar and Bitcoin in the month of February? I've chosen this project because I want to determine if as people begin seeing a depreciation in their own country's currency equaling a decline in their own fiscal value, if they begin seeking alternative options of places to store their wealth. In an era where cryptocurrencies have made decentralized banking possible, I would like to see if people are taking note of it and investing in this alternative option as opposed to taking the traditional route with currencies. All right, well, now that you understand the direction of my project, let me take you into some of the data that I collected and how I collected it. I collected data containing Bitcoin pricing and volume history for 4 different currencies: the US dollar, the euro, the Japanese yen, and the South Korean won. Collected all of this data off of a website called Crypto Compare that I'd highly suggest you visit if you're interested in cryptocurrencies. One of my favorite pieces of data that this website collects is Bitcoin volume by currency. This shows the percentage makeup of each currency's volume of exchanges between itself and Bitcoin. As of today, Japan dominates the marketplace with 42% of all exchanges, the US dollar at 32%, the euro at 7%, and the South Korean won at 5%. This is actually a little bit different than when I was checking it last week. Japan at that point was dominating around 60 to 65% of the marketplace. This company provides easy access to this data. You can export all of this data via a CSV file, which is what I did for this step. So as you can see, I've imported each of the respective CSV files for each currency from the site that I just showed you. Now each data frame will be holding the value of Bitcoin in terms of its given currency on any given day. It holds the volume of exchanges between that currency and Bitcoin and the value of the volume of exchanges. We will only be holding on to the volume of exchanges on any given day. As you can see, the euro starts recording values in 2011, the US dollar in 2010, the Japanese yen on the same day as the euro in 2011, and the South Korean won does not start until 2013, so we'll be imputing values in order to start all of them on the day that the yen and the euro start. So we will also be eliminating some values from the US dollar data frame. So we are getting rid of this first column due to the fact that it's just timestamp primary keys. From there, I needed to do something with the date column for each of the data frames. The date values were brought in as factors from the CSV file, so I needed to change them to date objects so I could compare them later. I then set the end date for each of the data frames to November 24th, 2017. From there, since I've determined that I would like to start all of the data frames at the date that the yen and the euro began exchanging with Bitcoin, I'm eliminating all values that the US data frame had recorded prior to that time, and that date was August 26, 2011. So at this point in time, I needed to begin imputing values into the South Korean won data frame due to the fact that there were no recorded exchanges prior to the year 2013. The way that I went about this was by creating a start row with a date value set equal to the starting date value of the other 3 exchanges. I then assigned 0 values to each of the columns due to the fact that there were actually no exchanges on this day. I did this so that I could create a time series object and begin imputing values on a daily basis. Essentially what happens in this imputation process is if there is a missing date between the start and the end date of the entire time series object, a value or a row value will be created for that date, and that date will take the values of most recent previous date with recorded values. This makes data imputation extremely easy, especially when all the values previous to the 2013 values will just be set to equal to 0. Um, from there, lastly, I just wanted to make sure that all of the time, date objects for each currency's data frame were equal to each other, which is true. So now that I know I've created 4 data frames, all containing um, information on the exchanges between its own currency and Bitcoin, and they all have values recorded for the exact same days. So now that I've successfully gathered, stored, and cleaned the data of the 4 currencies and their exchanges with Bitcoin over the period of time, I need to actually gather data pertaining to the values of each of these currencies over that same given period of time. For this data collection, I've decided to actually ping an API, specifically Quandl's currency API. I'll be comparing each of the currency's values to the British pound. So as you can see here, I'm gathering from the Quandl API the value of the Japanese yen in terms of Bitcoin. I'm basically taking a subset of that data in between these two date ranges, and you can see the values here are stored as so. I've done the same thing for the US dollar and the Korean won. I did the same thing for the euro, however, Quandl did not have an API for the pound to the euro. Instead, they had one from the euro to the pound. So I simply took that one and then did an inverse of each of the values, and that did the job. So after collecting this data, now it's time to go through the data and determine differences in date values in order to eliminate and impute differences so that we can create matching data frames for each of the currency value data frames. I recognize that the US had slightly different dates than the other 3 currencies, so I ran a set diff to determine what dates the US had that the other 3 currencies did not. Turns out that each of the differences were actually equal. So the US had these values right here and none of the other ones had it. So I took those out of the US value data frame and then came down and decided to run each currency with a set diff against the US. So flip the order a little bit in order to determine which dates the Japanese yen, the Korean won, and the euro had that the US dollar did not have. Turns out all of those dates were also equal, meaning that the Japanese yen, the Korean won, and the euro all actually had the exact same date values when being loaded in from Quandl, which is really nice. So these are the values that the US did not have that the other 3 did. So I actually went and discarded those values from these 3 currencies data frames, respectively. So at this point in time, I decided, all right, I need to impute the values due to the fact that the Bitcoin market's open 24/7. Currency markets are closed on holidays and weekends, actually. So I needed to do essentially the exact same thing that I did for imputing the values for the Korean won prior to 2013. However, this time they were going to be for the value of each currency. Again, I turned them all into time series object and imputed on a daily frequency where each new date that had not been recorded took the value from the previous date. So essentially, whenever you had a weekend, the Saturday and the Sunday would be taking the values from the Friday. This turns out to be very useful because as we come down here, I'm eventually going to be taking the delta between each day in order to calculate the percent change between values. So due to the fact we're at the 9-minute mark in this video and I'm a little bit behind where I want to be, at this point I'm going to kind of skip forward. Essentially all that I did to finish off the last step was trim the data frame of each currency's value to have a start date equal to each currency's data frame of exchange volume with Bitcoin. All right, so now we come down here and I'm making a new time series object based on monthly values. So all that this is going to hold is the first of each month for each currency's value. I turn them back into data frames so that I can compute a new column. This new column is going to hold the percent change in the value of each currency over a monthly time period. Now I did this for weeks also, but I don't have time to take you through it. So as we come down here, I perform the exact same series of commands as above, except this time it's on the data frames holding the exchange volumes between each currency and Bitcoin. I'm again creating time series objects in monthly intervals holding the very first value of the month. create new data frames in order to apply my delta function to get the change in value of the volume of currency or of exchanges between each currency and Bitcoin for a monthly interval. As we come down here, I needed to impute some values where the delta had been calculated to not a number or infinity due to 0 being divided into 0 or 0 being divided into 1. Now that the data frames holding monthly exchange volumes to Bitcoin and monthly change in a currency value have matching data frames in terms of time, I can display them both in time series graphs. As you can see here, the United States dollar has held the most activity in terms of exchanges between itself and Bitcoin up until about the last 2 years. At this point, the Japanese yen has taken over for the last year's interval. You could try and find some inverse correlations between the two of them. I've suggested above, however, it's not very visually pleasing, so let's look at the numbers instead. So in order to generate prediction models and determine any correlations between the exchange volume and the value of a given currency, I'm going to take the element of time series completely out of the equation. So in order to do this, I'm going to merge together the monthly data frame for the value of each currency and its delta, and then the monthly exchange volume of that same currency and its delta also. So as you can see here, this is the new data frame for the US dollar. I'm going to completely exclude the actual value and the volume value and just hold the delta for currency. I'm now going to shift the column that holds the delta of exchange volume for a given currency to Bitcoin by 1. This will enable me to look at a given currency's value change at a month, and in the same row, look at the next month's change in volume of exchange. This will enable me to be able to take out the need for the column that holds the value of date and no longer look at this as a time series issue. At this point, I've taken that out, and now here is the new data frame where I've combined the rows for each of the currencies holding their value change and the next month's change in exchanges between Bitcoin. I've been able to combine them all into one data frame because at this point it doesn't really matter which currency I'm looking at. All that I want to know is that if any currency changes in value, that its next month's change in volume of exchanges will go in the opposite direction. So now that the data is ready for models, it's time to start looking at the distribution of it. As you can see here, there are some obvious outliers due to the fact that if you look in the column that holds the exchange volume change of any currency, the mean is actually outside of the 75th percentile. We're going to come down here and we're going to eliminate all rows that have an outlier in either of the two columns. Come down here, we can see a plotted visual of monthly points of the change in the value of a currency versus the change in volume of exchange of that currency in Bitcoin. Now, if these two pieces of data were inversely correlated, then you should see most of the points along this line. Reason being that as the value for the currency goes up in a month, the volume should go down between the exchanges. And opposite being on this side, if the value goes down, then the volume of exchanges should go up. Now, it doesn't appear to follow that type of a trend, so unfortunately, it's looking like already most of our models are not going to be able to predict anything. As you come down here, you can get this correlation number via the data that we have provided without the outliers, and we're actually looking at a slightly positive number. Now, the correlation number in general is terrible here. It should be either 1 or be between 1 and -1, -1 being fully inversely correlated, and we're looking at a number around 0, so that is very unfortunate. Now, since I just showed you the extreme lack of correlation between those two data points, how they're currently set up, and I'm running out of time in this video, I'm going to save you the pain of sitting through that model because it wasn't pretty. We're going to come down here, and I'm actually going to do some more adjustments to the data set. I'm going to be taking out all values greater than 99 and less than -99. And I'm going to be taking out all rows with the currency exchange volume equal to 1, just because these were values that I imputed, and I think that they're holding up a little bit too much of the data set due to the fact that I collected data from a very long time ago, and a lot of the exchanges weren't even happening between those currencies and Bitcoin. Lastly, I attempted to scale and normalize the data in order to deal with some of the extreme fluctuations in the volume of exchanging values. So here's the same visual that we looked at above, except now with normalized values that are scaled and no extreme or moderate outliers. Still not looking like there's following much of a trend. However, we're going to do this one a little bit differently in the model. You can see by normalizing and scaling the data here, the distribution is a little bit better. The correlation of itself is now negative, which is awesome because I would like it to be inversely correlated. However, it's still very close to zero, so honestly, it's not significant at all. In order to utilize the linear regression model that I made, I created a training and a testing data set, pretty much just a random 50% sample is selected into each. I created the linear regression where the currency's change in value is trying to predict the exchange volume change. As you can see down here, we're getting the summary of the linear regression. I mean, the p-value is horrible, so the predictions are not going to be accurate. The correlation is not there. The adjusted R squared is also nowhere near it should be. Come down here, and I'm actually testing the prediction. And after calculating it out, I get an accuracy percentage of 31%. Now, for how horrible the p-value is and the adjusted R squared, you'd think it'd actually be lower, and it realistically is. However, I changed the way that I was calculating the accuracy to a close to equal function that I created. And essentially what that does, it's actually rounding up the value. So since the data frame or the data set has been normalized and scaled, the highest value that it has in there is 4, and the lowest that I have that it has is, I believe, -3. So really what I'm doing is I'm checking to see if the prediction, I'm not checking to see if the values are exactly the same. I'm checking to see if they're in the same kind of direction and at the same sort of magnitude. So, it predicts 31%, which is still pretty horrible, but better than what I was getting before. Lastly, I'll show you the database that I created for this project. I didn't really get to incorporate this into my project as much as I would have liked due to personal time constraints. However, it's a MySQL database. I only really had 2 tables in it. The first table was a table to hold the change in values versus the change in volume of exchanges between any currency and Bitcoin for any given time interval. And the second table was just a generic table to hold Bitcoin information for any given currency over any given interval of time. So yeah, as you can see, I just wrote some simple select statements to show that the information or the data that I had in my data frames was able to be selected out of the database and placed into the database. So yeah, thank you for watching my project. Unfortunately, there is no current inverse correlation between the value of a given currency and the future volume of exchange rate between that currency and Bitcoin. I wish there was because we could make some money, but sorry.